Debt financing, understanding borrowing and its implications. What is debt financing? When a company or person needs money, they can either borrow at debt or raise it by selling parts of their business equity. Here, we're focusing on borrowing or debt. Types of debt. Secured debt. If a company can't repay, the lender can take specific company assets. Think of it as a home mortgage. If you can't pay, the bank can take your house. Unsecured debt. It's like a credit card. Lenders can't seize specific assets if you don't pay. Private debt. Borrowing from a bank, like a personal loan. Public debt. Borrowing from the public, using tools like bonds. Syndicated loan. When one loan is too big for one bank, multiple banks team up. Imagine 10 friends each chipping in to lend you money. Specific terms. Coupon. Interest you pay on a bond. Bond. A promise by companies or governments to pay back borrowed money with interest. It's like an IOU with interest. Why borrow? Borrowing lets people and companies afford things they couldn't otherwise, like homes or equipment. Companies use loans to grow their business, but borrowing too much is risky. If they can't repay, they could face financial trouble. Why it's important to know understanding the differences in financing helps businesses make smart choices about how to get and use money. The right mix can lead to growth, while the wrong choices can lead to financial problems. Knowing about debt also helps investors decide if a company is a good place to invest their money. What is debt financing? Debt financing is when a company borrows money and promises to pay it back with interest. The people or organizations that lend the money are called creditors. Debt versus equity financing. Debt financing means borrowing money. Equity financing means selling shares of the company's stock to get money. In equity financing, the company doesn't have to pay back the money, but the investors get a share of the company's ownership. How debt financing works. Companies can sell bonds, bills, or notes to get money. People who buy these are lending money to the company. The borrowed amount principal has to be paid back by a certain date. If the company goes under, people who lent money creditors get their money back before shareholders do. Costs related to debt financing. Companies pay interest on borrowed money. This interest is the cost of debt. This interest payment is usually tax deductible, which means the company can deduct it from its taxable income. Measuring debt financing. A common way to check how much a company relies on debt is the debt-to-equity ratio D/E. A lower D/E ratio is generally better as it means the company has more of its own money equity compared to borrowed money debt. Interest rates. Interest is the cost of borrowing. Higher interest rates mean higher risk. Some lenders also set rules for the company to follow when they borrow money. These rules are called covenants. Debt financing versus equity financing. Debt. Money has to be repaid. Company keeps all its ownership. Equity. Money doesn't have to be repaid. Company gives away some ownership. Pros and cons of debt financing. Pros. Can leverage a small amount of money into a larger sum. Interest payments are tax deductible. The company doesn't give up ownership. Can be cheaper than equity financing. Cons. Interest has to be paid. Payments need to be made, whether the business is doing well or not. Can be risky, especially for new businesses. Examples and types of debt financing examples. Bank loans, credit cards, mortgages. Types. Installment loans. Borrowed money paid back in fixed chunks. Revolving loans. Like credit cards, borrow, repay, then borrow again. Cash flow loans. Paid back from business earnings, such as merchant cash advances. The essence, most companies will use debt financing at some point. It allows them to grow and buy what they need. The main thing to watch out for is making sure they can pay back the borrowed money. Debt financing can be valuable for growth, especially for new or small businesses. However, it's essential to ensure the company can handle the repayment commitments. Equity financing and debt financing. When a company needs money for long-term growth, it has two main options: debt financing and equity financing. Equity financing. It's like getting partners for your company. You sell parts of your company called shares or stock to investors. When people buy shares, they own a small part of the company. There are different types of shares, like common shares and preferred shares. Common shares usually let the owner vote on company decisions, while preferred shares usually don't allow voting but get dividends, a part of the company's profit first. Companies can sell shares to the public through a process called an initial public offering (IPO). However, when you sell shares, you're giving away some control of your company. Cost of equity. This is like the price a company has to pay to its shareholders for using their money. Shareholders expect returns for the risk they take by investing in the company. The higher the risk, the more return they will expect. Unlike the cost of debt, which can be easily seen like interest rates, the cost of equity is harder to determine. Simple example. Imagine you have a lemonade stand. You want to open 3 more stands in the neighborhood, but you don't have enough money. Equity financing. You ask 2 of your friends to give you some money. In return, they get a part of the ownership of all the lemonade stands. This means that if the lemonade stands earn money, they get a part of the profit. This is like selling shares. Cost of equity. Your friends agree, but they have a condition. Since they are giving you money and taking a risk, what if the new lemonade stands don't make a profit? They want a significant part of the profits or returns from all the stands. This is the cost you have to pay for using their money. Both ways help you grow, but in the first one, you share ownership, while in the second, you owe money. Importance. Why is understanding these methods crucial? It helps companies choose the best way to raise money while considering how much control they want to keep. Shareholders and lenders need to know the risks involved and what they can expect in return. Making the right choice between equity and debt can mean the difference between a company thriving or struggling. Understanding this is like knowing whether to ask your friends for money to build the treehouse and then sharing it, or borrowing from your sibling and then owing them. Making the wrong choice could lead to arguments or financial troubles. Debt and equity financing. Debt financing. What it is: borrowing money to be repaid at a later date, usually with interest. Debt financing refers to long-term loans or bonds that a firm needs to repay over a specific time frame, often with interest. It is appropriate for startups and mature companies, offering tax advantages and not diluting equity. Debt involves taking on loans or issuing bonds, where the firm is obligated to repay either the principal amount or interest to the lender or bondholder. Costs include potential bankruptcy and uncertainties regarding future financing needs. Example: think of it as a mortgage on a house. You borrow money to buy the house, and then you repay it over time with added interest. Debt financing. Advantages: provides access to capital without diluting ownership. Can offer tax advantages since interest on debt can be tax deductible. Might have better terms and interest rates than other financing options. Can allow for rapid growth. Tax benefits since debt payments are often tax deductible. Disadvantages: risk of bankruptcy if unable to repay. Requires regular interest payments regardless of business performance. Increases uncertainty about future financing needs. Requires regular repayments regardless of company's revenue. Risk of bankruptcy if unable to repay. Equity financing. What it is: raising money by selling shares or ownership in the company. Equity financing involves raising capital by selling shares in the business. It does not need to be repaid like a loan, but the business becomes beholden to its shareholders, aiming to produce consistent profits and pay dividends. The cost of equity is generally higher than the cost of debt, as it poses a higher risk to investors. Example: imagine you sell a piece of your business, say 10% to a friend for some capital. Advantages: no need to repay the money received from selling shares. No need to repay the funds or pay regular interest. Can bring in substantial capital, especially if company prospects are strong. Disadvantages: dilutes ownership, beholden to shareholders' demands and expectations. Potential for costlier capital given the higher risks for investors. The company becomes accountable to shareholders and must aim for consistent profits. often has a higher cost than debt because of the inherent risk to investors. How to choose between the two. Cost of capital. This is the cost associated with obtaining funds from either debt or equity sources. For debt, it's often the interest rate. For equity, it's the expected return shareholders want. The cost of debt is the interest rate charged by lenders, reduced by tax benefits. The cost of equity is calculated using the Capital Asset Pricing Model (CAPM), reflecting the return shareholders expect. GACC Weighted Average Cost of Capital, a formula that helps companies determine the most cost-effective mix of debt and equity financing. Companies should aim for a mix that offers the best funding at the lowest cost, often calculated using the weighted average cost of capital (WACC). Businesses aim to balance between debt and equity to achieve the most cost-effective financing, often using the weighted average cost of capital (WACC) to make the comparison. While both debt and equity financing have their merits and demerits, the optimal mix depends on the specific needs and circumstances of the organization. Companies should consider factors like the cost of capital, potential for growth, and risk tolerance when deciding between the two. Properly leveraging these options can optimize organizational growth. Equity financing. Equity financing is when a company gets money from investors in exchange for ownership in the form of stock. This can be either common stock or preferred stock. When a company wants to grow, it needs money. They can either borrow this money debt financing or ask people to invest in them equity financing. It's when a company gets money from people investors by giving them a piece of the company's stocks or shares. Benefits and drawbacks of equity financing. Pros. The company doesn't have to repay investors, even if things go south. No obligation to repay. If the company doesn't do well, they don't owe investors their money back. No debt. Unlike taking a loan, the company doesn't accumulate debt. Cons. The original owners lose some control over the company because they're giving away ownership to new investors. Loss of control. Since investors own a part of the business, they get a say in big decisions. Dilution of ownership. The original owners own a smaller piece of the pie. Common stock is preferred stock. Common stock. This represents a basic ownership in a company. Common stockholders can vote on company matters and get dividends. However, they are last in line to get any money if the company goes bankrupt. Like buying a regular slice of the company. You can vote on company decisions and might get a share of the profits. But if the company goes belly up, you're at the back of the line to get any money back. This is a standard type of stock that most people buy. People who own this can usually vote on company decisions and get dividends, a share of the company's profits. But if the company goes under, they're last in line to get any remaining money. Example. Think of it as buying a regular ticket to a concert. You get to see the show, but if it rains, you might not get a refund. Common stock pros, viz. Cons chance to grow money. If the company does well, the stock's price can go up, allowing you to sell it for more than you bought it for. Get a share of profits. Sometimes companies give out a part of their profits as dividends to stockholders. Voting power. You get to vote on some company decisions, like choosing the board of directors. Easy to sell. You can usually sell your stock easily if you want your money back. Cons of common stock. Risk of losing money. If the company doesn't do well, the stock's price might go down, and you could lose money if you sell. No guaranteed payments. Unlike some other investments, there's no promise you'll get dividends or any money back. Last in line. If the company goes out of business, other people get paid before common stockholders. You might get little or nothing back. No control over management. Even if you get to vote, larger stockholders or the company's preferred stock. These stockholders get dividends before common stockholders and have a higher claim on assets if the company folds. However, they usually can't vote on company matters, a special slice of the company. You get your dividends share of profits first, and if things go wrong, you're ahead of the common stock folks to get your money. But you usually don't get to vote on company stuff. This is a special kind of stock. Owners get dividends before common stockholders, And if things go bad, they're ahead in line to get their money. They usually can't vote on company decisions. Example, this is like a VIP ticket. Even if it rains, you get some perks, maybe even a refund. There are various types of preferred stock. Cumulative preferred stock. If dividends are missed, they add up for later payment. If the company misses paying you this year, they owe you for next year. Non-cumulative preferred stock. Missed dividends don't add up for future payment. If they miss a year, you're out of luck. Convertible preferred stock. Holders can swap this stock for a set number of common stock shares. You can swap this for common stock if you want. Participating preferred stock. These holders get their usual dividends and may get extra if the company hits financial targets. You get your regular share and maybe a bonus if the company does really well. Pros and cons of preferred stock. Pros. Priority. They get paid before common stockholders. Fixed dividends. They usually know the exact dividend amount they'll receive. Cons. Limited upside. Their dividends are fixed, so if the company does really well, they might miss out on higher profits. No voting rights. They usually can't influence company decisions. Debt is equity in organizational growth. When a business wants to grow, it needs money. It can either borrow this money, debt financing, or get it from investors' equity financing. Equity financing, through selling stock, means the company doesn't owe money later, but they give away some control. Debt means they owe money later, but they keep full control. Costs of equity financing. Selling shares can be expensive. There are fees and costs involved. Companies need to think about this when deciding how to get money. Getting money through selling stocks has some costs, like legal fees or the cost to set up the sale flotation costs. There are formulas to figure out these costs. Role of financing in growth. Choosing between debt and equity financing can influence a company's growth. Equity might be safer because there's no debt to repay, but it dilutes ownership. Debt can be risky if the company can't pay it back, but it preserves ownership. The key is balancing these options for optimal growth. Companies can raise money by selling ownership shares. There are different types of shares, each with its own perks and risks. Selling shares can be expensive, and companies need to weigh the costs and benefits. When a company wants to grow, it can either borrow money, debt, or sell parts of its self-equity. Each option has its pros and cons, and the choice depends on what the company feels is best for its future. Why is all of this important? Companies need to grow, and growth needs money. Choosing between debt borrowing and equity getting investors is a big decision. It affects how much control the original owners have and how much risk they take on. For a company, deciding between debt like loans and equity selling stock is crucial. It can affect how much control the owners keep, how much profit they get, and the company's growth potential. Understanding the difference between common and preferred stock is important for investors, as it affects their potential profits and risks. Example, imagine you want to open a lemonade stand. You could borrow money from your sibling debt, or ask your friend to chip in some money in exchange for half the profit's equity. Borrowing means you owe your sibling regardless of how well you do, but you keep all the profits. Partnering with your friend means you don't owe money, but you share the profits and maybe the decision on which lemons to buy. Business life cycle, how businesses choose between borrowing money, debt, or getting investors' equity to grow, based on their stage in business. Businesses grow and change over time, just like how people grow from babies to adults. As they grow, they need money for different reasons. Here's how they get that money at each stage. Starting out, first stage, baby stage. What's happening? A new company has a fresh idea but little money. Money needs very high. They need funds to bring the idea to life. How they get money? Mostly by taking loans, debt. Sometimes they find investors willing to bet on their idea, especially if it promises big growth. They have a new idea and need lots of money to make it real. They usually borrow money called debt or get some from friends and family. Needs: lots of care and water money. How you get it? Borrowing a bucket of water from a neighbor, taking a loan or debt, or collecting rainwater with the help of friends and family, getting investments from close ones. Example: Sarah starts a cake shop and borrows money from the bank to buy equipment. Why it's important. Without the initial money, Sarah can't even start her business. Pros: quick money to start. Cons: you have to return borrowed water with some extra interest on the loan. Growth second stage, teenage stage. What's happening? The company's idea is working and they want to reach more customers. Money needs still high because they want to expand quickly. How they get money? They might get special investors called venture capitalists or give away parts of the company equity for money. Their idea is working and they want to make it bigger. They might get money from special investors who like big, new ideas called venture capital, or they might sell parts of their business to get money called equity. Needs more sunlight and bigger space. How you get it? Moving to a sunny spot in the garden, raising money by selling a part of your company or equity, or getting a fancy sprinkler system from an expert gardener. Venture capital. Example: Sarah's cakes are a hit. She sells part of her business to investors to open more shops. Why it's important. This helps her business grow and reach more people. Pros: big funds for expansion. Cons: Sarah now shares her profits with the investors. Maturity third stage. Adult stage. What's happening? The company's growth is slowing down. Most people who want their product or service already have it. Money needs lower than before. They might have some money saved up from their profits. How they get money? They can borrow or get more investors, but they don't really need as much money as before. Growth slows down, but they have some saved money. They can still borrow money or get investors, but they don't need it as much. Needs basic care and maintenance. How you get it? Using the saved water in a tank, using company's saved profits or retained earnings. Example: Sarah's cake shops are everywhere. She uses her profits to maintain and improve them. Why it's important. This helps maintain her reputation and quality. Pros: no need for external money. Stable growth. Cons: growth rate is slower. Decline final stage, old age stage. What's happening? Sales are going down because there's a newer product or a better competitor. Money needs very low. They might not need external funds anymore. How they handle money. They might pay off their loans or buy back parts of the company they previously sold to investors. Things aren't going as well. Maybe there's something newer or better out there. They don't need much money from outside. They might pay back old loans or buy back parts of the business they sold before. Needs less water. Might need pruning. How you get it? Using the remaining water wisely and maybe returning some borrowed water back. Example: new cake trends emerge. Fewer people visit Sarah's shops. She closes a few and returns some of the borrowed money. Why it's important. Helps to manage a tough time without collapsing. Pros: reduces debts and liabilities. Cons: business shrinks, less revenue. Why is this important? Understanding where a business is in its life helps decide how it should get money. A young business might not attract big investors, while the mature business might not want to take on too much debt. Pros and cons. Debt: borrowing money. Pros: don't give up ownership. Fixed costs: know what to pay back and when. Cons: have to pay back even if the business isn't doing well. Too much debt can be risky. Equity: getting investors. Pros: don't have to pay back if the business fails. Can bring in expertise and connections. Cons: give up some ownership and control. Might have to share profits. In a nutshell, businesses, like people, have different needs at different times. They can borrow money or get people to invest in them. And knowing when to do which can help them grow and succeed. Just like a tree needs different care as it grows, a business needs different kinds of money. Choosing the right kind helps the business grow healthy and strong. Long-term versus short-term financing. What is long-term financing? Used primarily for acquiring assets, research and development, enhancing cash flow, and company expansion. Sources can come from self-generated capital by the company or by issuing new debt and equity. It is for assets and projects. Money borrowed or raised for a longer period, often for buying big assets or expansion. Examples: equity, corporate bonds, capital notes. Used for buying equipment, research and development, improving cash flow, and expanding the company. Types of long-term financing: equity financing. Selling shares of stock. It doesn't require repayment but dilutes ownership and may cost more than debt. Selling part of your company shares to an investor. Imagine you own a bakery and you sell 10% of your company to an investor for funds. Corporate bond. A long-term loan where the company promises to pay back the borrowed amount plus interest. Like a long-term loan where you promise to pay back with interest. Like borrowing money from friends with a promise to pay back in 3 years with some extra. Capital notes. Convertible securities that can be turned into shares. Issued often during restructuring. A promise to give someone shares in your company in the future. It's like promising your bakery partner that in return for their help now, they'll get more shares in 2 years. Why it's important. Allows businesses to grow and expand, buy important assets, or invest in research and development. Pros. Stable and predictable funds, potentially lower interest rates. Cons. Might lose some control of your business with equity, long-term commitment. Examples: equity, selling shares of your company, corporate bonds like a long-term loan from investors, capital notes like IOUs that can turn into shares later. What is short-term financing? It is for ongoing operations. Helps businesses manage daily expenses like inventory orders and payrolls. Money for immediate needs, often for daily operations. Examples: commercial papers, promissory notes, asset-based loans, used for increasing inventory, paying salaries, and daily operations. Types of short-term financing. Commercial paper. Short-term unsecured loans issued by large companies. A short-term IOU. It's like a post-dated check from a trustworthy friend. Promissory note. A written promise to pay a specific amount in the future. A written promise to pay back money. Like lending money to a cousin who gives you a note promising to pay back next month. Asset-based loan. A loan backed by the company's assets like real estate or equipment. A loan backed by something valuable. Imagine you get a loan and use your bakery oven as collateral. Repurchase agreements. Selling something with a promise to buy it back. Like selling your car to a friend with a promise to buy it back in a month. Repurchase agreements. Short loans where securities are sold and then bought back at a set date and price. Letter of credit. A guarantee by a bank that a seller will receive payment. A bank promises to pay if the buyer can't. Imagine a bank promising a flour supplier payment, ensuring you get flour even if your bakery is short on cash. Why it's important: helps businesses manage everyday costs and operations without a hitch. Pros. Quick to get, flexible. Cons. Higher interest rates, short repayment periods. Examples: commercial paper, a short-term IOU without collateral. Promissory notes, a written promise to pay later. Asset-based loans, borrowing against things you own. Repurchase agreements, selling something with a promise to buy it back soon. And letters of credit, a bank's promise to pay a seller on a buyer's behalf. Management's role: ensure the right type of financing is used for the right needs to keep the business healthy and growing. It's like ensuring you use the right ingredients in the right amounts for a bakery recipe. The result is delicious success. Pros and cons. Equity financing. Pros. No need to repay, less cash flow risk. Cons. You might own a smaller part of your company. Potential loss of some control. Might cost more in the long run. Corporate bond. Pros. You get to use the money without giving up ownership. Tax benefits, since interest can be deducted. Cons. Need to pay interest and repay the bond at the end. Short-term financing, e.g., commercial paper. Pros. Quick money for immediate needs. Cons. Need a good credit rating. Can be risky if you can't pay it back quickly. Overall importance. To optimize growth, businesses must decide on the best mix of long-term and short-term financing. They should weigh the costs, benefits, and risks associated with each type. Remember, it's essential to match the financing type with the company's needs to ensure financial stability and growth. Choosing between long-term and short-term financing is crucial for a business's growth. It ensures that a business doesn't run out of money for daily operations or when looking to make bigger investments. Each method has its benefits and drawbacks, so it's essential to choose wisely based on the company's situation. Timing and cash flow. Businesses must ensure they have the right kind of money, short or long term, to match their needs. It's like using a monthly salary for daily expenses and a year-end bonus for a big purchase. Companies should match their financing type, long-term or short-term, with what they're financing in terms of timing and cash flow. Debt like bonds might be cheaper than equity because interest is deductible. However, debt requires regular repayment, which can be a cash flow burden. Debt-to-equity ratio, D/E ratio. What is it? The D/E ratio tells us how much a company relies on debt versus its own funds equity to run its business. The D/E ratio measures how much of a company's operations are funded by debt compared to equity. A higher ratio means the company relies more on borrowing. A lower ratio indicates more reliance on owner funds. The debt-to-equity D/E ratio indicates how a company finances its operations through debt versus its own funds. Simply put, it tells us if a company has more debts or more equity ownership. Formula: total liabilities divided by total shareholders' equity. Example: if a company has $2 million in debts and $1 million in equity, the D/E ratio is 2. This means for every dollar of equity, there is $2 in debt. Why does it vary? Capital intensity. Some industries need more money to operate, like the telecom sector, which spends a lot on infrastructure. Nature of business. Some businesses can handle more debt. Utility companies, for instance, have a steady income and can afford more debt. Different businesses have different needs. Some need a lot of money to start and run, like telecom companies who lay down cables, so they might borrow more, leading to a high D/E ratio. Some businesses can manage more debt because they have stable incomes, like utility companies who provide water or electricity. These companies might have high D/E ratios, but it isn't necessarily risky for them. Nature of the industry. Capital-intensive industries like oil or telecom require more upfront investment, so they often have higher D/E ratios. Stability of revenue. Industries with stable income, like utilities, can handle more debt since their earnings are more predictable, which industries have high D/E ratios. Financial institutions have naturally high D/E ratios because borrowing and lending money is their core business. Capital-intensive industries, such as airlines, also tend to have higher D/E ratios. High D/E ratios can sometimes mean more risk. If a company has too much debt, it might struggle to pay it back, especially if the business isn't doing well. However, in some industries, a high D/E ratio is normal and not a big concern. Financial services, they borrow to lend. A high ratio isn't necessarily risky for them. Utilities, they have a steady income and often operate without competition in their regions. Capital-intensive industries, like airlines and manufacturers, which require large investments. Why is this important? Investors use the D/E ratio to gauge a company's risk. High debt can be concerning, especially if the company isn't growing. However, low D/E might suggest the company isn't maximizing its assets. Importance of D/E ratio. Investors like companies with low D/E ratios. Why? Less risky. If a company goes under, those with more equity can pay off their debts. Financial soundness indicates the company can finance its operations without relying too much on external debts. However, too low can mean the company isn't using its assets to grow. Common versus preferred stock. Common stock. What is it? It's a type of ownership in a company. When you buy common stock, You get certain rights like voting on company decisions. Represents ownership in a company and comes with voting rights. Shareholders might get dividends, but there's no guarantee. In case of bankruptcy, they're last in line to receive any assets. Common stock can be voting or non-voting. Pros. Over time, common stock can give better returns than preferred stock. You get a vote in company matters. Cons. If the company goes bankrupt, common stockholders get paid last. No guaranteed dividends. Example. If you own common stock in a tech startup, you can vote on company decisions. However, if the startup goes under, other people get paid before you. Preferred stock. What is it? Another type of ownership in a company, but with some special rights. Owners have a higher claim to dividends and assets than common stockholders. A mix between a bond and stock. Does not usually have voting rights. Dividends are typically guaranteed. Preferred stockholders don't usually have voting rights. Pros. They get dividends before common stockholders. If a company goes bankrupt, they get paid before common stockholders. Cons. Generally, no voting rights in company decisions. Example. If you own preferred stock in a bank, you get dividends regularly. But if the bank has a big decision to make, you probably won't get a vote. Why is this distinction important? Investment decisions. Knowing the D/E ratio and the type of stock helps investors understand the risk and potential rewards. Company health. For a company, the D/E ratio can indicate if they're over-leveraged or underutilizing assets. When making financial decisions, it's crucial to know the benefits and risks associated with each type of stock. Preferred stock is seen as less risky in terms of dividends, but they often don't offer as much growth potential or influence in the company as common stock. Pros of D/E ratio. Insight into leverage. Helps see how a company is financed. Comparison. Can compare companies in the same industry. Cons of D/E ratio. Not always indicative. A high D/E ratio in banking isn't the same as in tech. Industry variance. Without industry context, the D/E ratio can mislead. Conclusion. The D/E ratio, common stock, and preferred stock are all tools that help investors understand a company's financial health and risk. Depending on the industry and the company's growth phase, these metrics can have different implications. The D/E ratio shows if a company uses more borrowed money or its own money. It's okay for some companies to have high debt, but for others, it might be risky. When you invest in a company, you can buy common or preferred stock. Common stock lets you vote on company decisions, but doesn't guarantee dividends. Preferred stock gives dividends first, but usually doesn't allow voting. In essence, D/E ratios help assess a company's financial risk, while the type of stock, common or preferred, offers different benefits and risks for investors. Proxy voting. As a shareholder, you have a say in major company decisions, even if you can't attend the actual meetings. Before the company's big yearly meeting, shareholders get a package. This package contains information about the company's financials, major plans like company changes, and any big deals or mergers. If you can't attend the meeting, there's a solution: proxy voting. This means you can let someone else vote on your behalf. This could be someone from the company's team or another representative. When you own shares in a company, you get the right to vote on big decisions that affect the company. If there's a major meeting but you can't attend, you'll still get a say by voting through a proxy. This means you let someone else cast the vote on your behalf, typically based on your instructions. What is proxy voting? It's like giving someone else permission to vote for you when you can't attend a meeting. Proxy voting lets shareholders vote on company decisions without attending meetings in person. Think of it like mailing in your vote for a national election if you can't go to the polling station. Example: imagine you own shares in Toyco. They're having a meeting to decide if they should launch a new toy. You can't attend the meeting, but you still want to say. Through proxy voting, you can delegate your vote to someone who's attending or vote electronically. Why is proxy voting important? Ownership. Even if you can't be there, you still have a say in big company decisions. Influence. Shareholders guide the direction of the company. Proxy voting ensures your voice is heard. Global reach. You can own and influence companies worldwide without needing to travel. It lets shareholders influence how the company operates, its rules, and other big decisions. Typically, shareholders get one vote for each share they own. If they don't vote, it's like they didn't say anything. Information. The internet makes it easy to get details, vote online, and see how big players like institutions plan to vote. With modern technology, shareholders can vote online. This means even if the company is on the other side of the world, they can still have their say. Big investors, like institutions, often share their voting choices online. This can help individual investors see what the big players are thinking. In some cases, these big institutions talk directly to the company to discuss, change, or even cancel proposals. How does it work? Before a company's big meeting, shareholders get documents in the mail or online that detail what will be voted on. If shareholders can't attend the meeting, they can allow someone, often a company executive, to vote for them. Why is it important? This is how shareholders, the real owners of a company, have a say in how the company is run. Even if they're far away, they can influence decisions. With the internet, this process has become easier. Shareholders can receive documents and cast votes online. New changes in proxy voting. After some big company scandals, there have been talks about changing how proxy voting works. Now, if you've owned a significant amount of a company's stock for over a year, you can suggest changes. This means shareholders can even suggest who should be on the company's board of directors. This can bring new ideas, but can also be risky if the wrong person is chosen. Today, shareholders who've owned a certain amount of a company's stock for at least a year can suggest new items to be voted on. This gives shareholders more influence, but there are pros and cons. New ideas can be good, but they might also be not ideal for the company. Pros is cons. Pros. Convenience. You can vote without being physically present. Informed decisions. Online resources help shareholders understand issues better. Greater inclusion. More people can participate, including those who can't travel or attend in person. Transparency. Many big investors share how they're voting, giving you more insight. Democracy in action. Even if you can't attend, your voice as a shareholder is heard. Convenience. With the internet, you can vote online, making the process smooth. Transparency. Big investors often share their voting decisions online, helping smaller investors make informed decisions. Pros, these cons. Cons. Misinformation. Online sources may not always be accurate or unbiased. Potential for misuse. Some may influence proxy votes for their own benefit. Oversimplification. Electronic systems might simplify choices, potentially missing nuances. Experience gap. New rules let more people suggest company decisions, but they might lack the experience to make the best suggestions. Overwhelming information. The package sent before voting can be dense and tough to understand. Potential misuse. Bigger institutions can have a lot of sway and might not always align with smaller shareholders' interests. Inexperienced choices. With the newer system, shareholders can suggest board members, but without proper knowledge, they might suggest someone unfit for the job. In conclusion, proxy voting lets shareholders have a voice in their company's big decisions. Even if they can't attend meetings, they should make sure to understand the issues and vote wisely. Proxy voting ensures every shareholder gets a voice, whether they're in the room or across the globe. It's crucial to stay informed and vote wisely for the benefit of the company and your investment. Common is preferred stock. Common stock. When you buy common stock, you're purchasing a piece of the company. You might get a say in company decisions through voting. However, if the company goes under, you're at the end of the line to get any leftover money. Ownership in a company, usually with voting rights but dividends aren't guaranteed. Common stockholders get paid after preferred stockholders. Preferred stock. This is like the VIP version of common stock. You typically don't get to vote on company decisions, but you get dividends, a share of the profits, and if the company goes belly up, you're ahead of common stockholders to claim any remaining assets, a special type of ownership that is a mix between a stock and a bond. It usually doesn't have voting rights but does give priority for dividends and in case the company goes bankrupt. Why it's important. Understanding the difference helps investors choose what's right for them. Some want more control and potential growth common stock, while others want more security and consistent returns preferred stock. Key differences. Dividends. Preferred stockholders usually get a fixed dividend, and they're paid before common stockholders. Liquidation. If a company shuts down, preferred stockholders are ahead in line to get any leftover money after bondholders. Asset priority. If a company goes under, preferred stockholders are higher up the line than common stockholders to get paid, but after bondholders. No voting rights. Usually, preferred stockholders can't vote on company matters. Voting rights. Common stockholders often get to vote on company issues, while preferred stockholders usually don't. Convertible. Some can be changed into common stock. Callability. The company might buy them back. Ratings. Just like bonds, they have ratings to show how risky they are. Variety. There are many types like convertible preferred stock, cumulative preferred stock, etc. Why this is important. For companies, preferred stock is a tool to raise money without giving away too much control voting rights. It's like borrowing money, but in a different style, allowing flexibility. For investors, it's a safer option compared to common stock. If things go south, they have a better chance of getting some money back. Pros and cons. Pros of preferred stock. Fixed dividends. Investors get a predictable income. Safety net. They're ahead of common stockholders if the company fails. Flexibility for companies. Companies can delay dividend payments without legal consequences. Capital raising. It's easier for companies to raise higher amounts. Cons of preferred stock. No voting rights. Less influence on company direction. Capped gains. Unlike common stock, the growth potential is limited. Dividend not guaranteed. If the company faces financial difficulty, dividends can be delayed. Why do companies offer preferred stock? Raise money. Companies can get a lot of capital quickly. It's like a shortcut to funding. Companies can raise money by selling preferred stock. For instance, Bank of America and MetLife have done this. Flexibility. Companies can delay paying dividends to preferred stockholders if they're having money troubles. If a company has money troubles, it can delay paying dividends to preferred stockholders without going bankrupt, unlike not paying bondholders. Attract big investors. Large institutions often buy preferred stocks because they're a safer bet and offer dividends. Avoiding debt. Preferred stocks provide money without adding to the company's debt, making the company look better financially. Defense strategy. Some companies use preferred stocks to defend themselves against takeovers by making the stocks expensive to buy out. In a nutshell, think of it like seats on an airplane. Common stock is like economy class. You get to where you're going, and it's affordable. Preferred stock is like first class. More benefits, higher priority, but typically no say in how the plane is flown. It's up to you to decide which class suits your journey. Think of common stock as a basic seat at a concert. You get to experience the show benefits/profits of the company, but no special privileges. Preferred stock, on the other hand, is like a VIP ticket. You might not get to request a song vote, but you get front row seats, priority access to goodies, and you'll be one of the first to exit if there's an issue.